Okay, let's go ahead and get started. I'm Charlie Smith, the Executive Director of ESIG. Nice to see everyone here heading into the last few weeks of summer, and welcome to our ESIG monthly webinar for August. It's been a pretty hot and brutal summer all over the world with the unprecedented heat, droughts, floods, and wildfires, which serves to remind us of the big job still ahead of us. For those of you not familiar with ESIG, we are a membership-based nonprofit organization providing our members with objective information, resources, and networking opportunities in support of the energy transition. We do this through workshops, tutorials, webinars, blogs, working group and task force activities, and producing technical resource materials. ESIG also serves in a leadership role with the Global Power System Transformation Consortium, the GPST, whose mission is to bring together key actors to catalyze a rapid, clean energy transition at unprecedented scope and speed. ESIG leads Pillar 1 of the 5 pillars, which deals with the research agenda for the system operators. We just finished 2 of our more topical workshops in Denver in June, one on forecasting and markets, and the other on long-term load forecasting under an accelerating time frame for DER applications and electrification of load. And now we're deep into the preparations for the fall workshop in San Diego at the end of October. I can assure you we'll have another great lineup of tutorials and technical sessions, and I hope to see you there. Further information can be found on the website, where the final agenda will be posted in the next day or 2. Our workshops and monthly webinars are open to everyone, so please feel free to register anytime on the ESIG website. If you're new to ESIG, I strongly encourage you to follow up with us if you like what you hear, and I think you'll be pleasantly surprised. ESIG membership will give you an opportunity to participate actively in all of our working groups and task forces. You can find us on the web at esig.energy, as well as on LinkedIn, Facebook, Twitter, and YouTube. Okay, just a few logistical matters before we get started. First of all, phones will be muted for the duration of the webinar to avoid unnecessary distractions. For the Q&A, we're using the Slido platform. So to ask your questions, please go to slido.com and enter ESIG10 as the event code. The instructions are also at the bottom of this screen. You'll see a thumbs up button next to the questions to allow you to cast a vote to help prioritize the questions submitted. We plan to save 10 minutes or so for Q&A at the end and then wrap it up at the top of the hour. An email with a link will be provided once the video file has been posted. We also plan to provide short responses to unanswered questions after the webinar, so please don't be afraid to ask your questions through Slido. Okay, today's topic is going to be on the marginal emission rate and its application in voluntary clean energy investments. This is a topic of increasing interest and importance, with many corporations relying on clean energy power purchase agreements as the foundation of their decarbonization strategy. And here to talk with us about it today is Hank He, who is a consultant at Tabors, Caramanis, Rudkevich, or TCR, a Boston-based energy economics consulting firm. Hank has 10 years of experience in power market modeling and data analytics, and advises clients on decarbonization strategies, among other things. TCR is a valued member of ESIG, and it is my great pleasure to welcome Hank here today. Today's webinar will look beyond megawatt-hour matching of RECs from clean energy PPAs to discuss some new tools and metrics to guide clean energy investment. Locational Marginal Carbon Emission Rate, or LMER, provides a transparent and reliable way to account for carbon impact of grid-connected resources. This presentation will provide an overview of the calculation of LMER, reflecting granular, locational, and temporal change in carbon intensity, and introduce a carbon accounting framework based on LMER and LMER's application in voluntary clean energy procurement. I greatly value the contributions of TCR to ESIG and the industry, and I look forward to what Hank has to say. Just a short reminder once again to use Slido at slido.com with the event code of ESIG10 to ask your questions. Okay, without any further ado, let's go ahead and get started. Hank, I will now turn it over to you.
Thank you, Charlie. It's a great introduction. So let me start sharing my screen and get this started. Can everyone see my screen?
Yep, it looks good.
Cool. All right. So today's topic, we're going to be discussing, the marginal emission rate and its application in voluntary clean energy procurement. I will cover, I'll break my webinar into 3 parts. The first part will briefly go over the history of voluntary procurement of renewable energy in the US and the current GHG protocol that guides such investment. Secondly, we'll talk about what is locational marginal emission rate and why it's a much needed tool to improve the effectiveness of voluntary procurement in combating carbon emissions. And thirdly, we'll talk about some applications of LMER currently in voluntary renewable procurement, how industry practitioners are thinking about it, and what has been done and is on the roadmap to be done. So over the past decade, the US power grid has seen an explosion of renewable project addition, particularly wind and solar. Altogether, we added about 150 gigawatts of new solar and wind capacity since 2014. And unbeknown to some, a large fraction of those additions are caused by, is a result of voluntary corporate procurement.
Hank, I may have spoken too soon. I still see the title slide on the webinar. I don't see your presentation.
Interesting. Let me start again.
Okay, yeah. Now I see it.
Okay, yeah. So as a matter of fact, corporate voluntary procurement accounted for 65 gigawatts of the 150 gigawatt new renewable addition. That's more than 40% of all the renewable capacity we added since, in the past 10 years. Corporate buyers procure virtual PPAs from wind and PV generators for 2 reasons. The first is to serve as a financial hedge for energy price volatility. And secondly, the renewable procurement provides them a way to contribute to carbon emission reduction and take credit from these renewable generation towards their corporate sustainability goals. As you can see from this graph, the corporate procurement saw a steep increase after 2014. That's a year that the World Resources Institute published the Greenhouse Gas Protocol Scope 2 emission guideline. This guideline provided a framework for corporations to take credit for the renewable energy they bought and invested through virtual PPAs. Sorry, I think this Charlie, can you still see my screen?
I did for a minute. It's back to the introductory slide. I can see it. It's back up now. Slide 5.
Okay, sure. Yeah. So a brief interview of the Greenhouse Gas Protocol. Greenhouse Gas Protocol Scope 2 guidelines provided a way for corporations to use a combination of renewable energy credits and average emission rates to track their emissions. This framework incentivizes corporations to procure as much megawatt hours of clean energy as possible so they can take credit for the REC credit that this generation produces. To give some very high level example of how REC can be used in corporate sustainability accounting. Suppose we have a company that uses 100 gigawatt hour of load every year and procures 100 gigawatt hour of renewable energy through either virtual PPA or unbundled RECs. They can claim that because their load is entirely offset by renewable REC credits, then they have zero net load and can claim that they have zero Scope 2 emission. And suppose they only procured 50 gigawatt hour of REC credits for their 100 gigawatt hour of load, then what they can do is to take the difference between their load and rec credit to calculate their net emission, and then use a grid average emission rate to calculate their carbon footprint. So, it's in the past year, the average emission rate for the US grid is about 855 tons per megawatt hour. And in this hypothetical example, our corporate practitioner is responsible for 42 million pounds of carbon emissions. Greenhouse gas protocol, as I mentioned, was a catalyst for corporate voluntary renewable energy investment in the past 10 years. It played a vital role in adding that 65 gigawatts of renewable capacity into our power grid. However, as the grid starts to evolve and we see more and more renewable energy being added, a more precision and transparent tool is needed to guide future renewable investment to make the most impact onto the grid. And before we introduce marginal emission rate, let me just briefly go over some of the drawbacks of the react-based and average emission rate-based carbon accounting and the signals they provide for renewable investment. Over the past decade, as we mentioned, we added a tremendous amount of renewable energy capacity into the US grid. The total wind and PV capacity in the US grew from 50 gigawatts to 250 gigawatts in 2002. That's an increase from about 5% of total capacity now to 20%. And as I said, GHG protocol provided a catalyst for voluntary procurement action that contributed greatly to this addition. However, as I previously described, GHG protocol incentivizes corporations to focus on procuring as much megawatt hours of renewable energy as they can, regardless of their location and generation profile that's dictated by the technology of the projects they invested in. As a result, voluntary buyers tend to pick up projects wherever available. And a lot of renewable projects has been added in ERCOT and CAISO in the past few years. And that created a problem for some of these PPA projects. As more and more projects are added, we are seeing widespread curtailment, especially in ERCOT and CAISO. These recs are not contributing as much to carbon emission reduction as they did 10 years ago. As a matter of fact, last year, ERCOT saw tremendous curtailment throughout the entire system. About 5% of total wind generation was curtailed, and utility PV curtailment was 9%. That adds up to about 8 terawatt hours of energy going wasted that would otherwise be used to displace thermal generation and displace carbon. Just put this into context, an average household consumes about 10 megawatt hours of energy every year. 1 terawatt hour of energy could serve approximately 100,000 households. So that's a tremendous amount of energy that's going unused. If we think from investment from a carbon displacement perspective, ERCOT does not need more PV to be added into the system. However, the react-based accounting framework does not send that signal to corporate buyers when they are doing their voluntary procurement action. Similar thing happens in CAISO. In the past 10 years, CAISO saw steady increase in curtailment of wind and PV energy. In 2014, when this GHG protocol was first published and kicked off voluntary procurement action in the US, there was virtually no curtailment of renewable energy in CAISO. Right now, last year, we stand at a total curtailment of 2.5 terawatt hours annually. And right now, only halfway through 2023, we are already at the 2.0 terawatt hour mark. And this will continue to increase, and more corporations are looking to use voluntary procurement to reach their net zero or carbon neutral goal. And the second tool that was widely used in the GHG protocol is grid average emission rate. And unfortunately, as more renewable energy asset is added and more curtailment and congestion happens on the grid, average emission rate does not provide the sufficient information to guide investment towards areas where they can, most carbon displacement result can take place. Take a look at this average carbon emission rate curve from CAISO on June 30th, 2023. Let's see, last day, that's the latest emission rate data that I got from CAISO. This curve represents a typical dot curve you see in CAISO. PV generation picks up during midday in CAISO, drives down net load and generation. If I'm a battery operator or a dispatchable load or demand response operator in CAISO, looking at this graph, my course of action would be that I should shift most of my load to midday in CAISO because it's where average emission rate is the lowest, and I should avoid using energy during the shoulder hours in early morning or late afternoon. Or if I'm a battery operator, I should charge my battery during noon this day and discharge my battery late afternoon or discharge it early in the morning. However, if we take a closer look under the hood and look at CAISO's curtailment data, which they publish on a daily basis, we can see that this course of action actually would not necessarily be the most efficient way to displace carbon. These two stacked bars I show represent the curtailment report from CAISO. The dark gray bar represents local curtailment. This is CAISO's terminology to say renewable curtailment because of transmission constraint, pocketing certain renewable in areas that cannot be transported out into load centers. And the light blue bar shows what CAISO calls system curtailment. This means the curtailment is happening because there's system oversupply, not transmission issues. So actually, if I look at this curtailment graph, my power industry background tells me, even though the emission rate is low at the middle of the day, there are pockets of the CAISO system where curtailment is happening, and the marginal generator is PV. So if I use more load there, I am indeed observing low emission rate because any more load being used would just use up the curtailed PV generation. But on the other hand, because this curtailment is local in nature, which means other areas still rely on thermal generation to serve as marginal generator. So if I use energy at the other end of the transmission constraint, I am actually using dirty thermal generation to charge my battery or serve my load. But looking at the average emission rate graph, I do not know where the curtailment is happening and where emission rate is actually low and where emission rate would be higher than average because it's served by thermal generation. And looking at late afternoon and 6 and 7 p.m., even though the emission rate graph tells me that I should be discharging my battery here or reduce my dispatchable load during these hours, the market is actually experiencing renewable oversupply because CAISO operators need to ramp up thermal generation, so they need to curtail down the overall PV supply in the system. So looking at this curtailment graph, even though average emission rate is higher than noon, it's still a good time to charge your battery or use or rank up your load because you would be consuming the curtailed PV generation in the late afternoon. That is also something that is not visible just by looking at the average emission rate graph. So to understand what is the actual emission impact of assets, generation, and load in the system, we need more granular data, both locationally and temporally. As we know, as power market professionals, every injection and withdrawal of energy on the system at every individual node have system impact because of a change in system dispatch. When we look at pricing energy in a deregulated market, we use a pricing mechanism called locational marginal price. So this means every incremental load at a given substation on the system will have a system-wide dispatch of of generators, and the resulting change in system cost is the locational marginal price at this node. And that has been done in the past 2 decades in 7 markets throughout the US. The same concept can be applied to emission impact of every injection and withdrawal of energy at every given node. So the concept of locational marginal emission rate is very similar to the locational marginal price that's already been used. No, mathematically, the locational marginal emission rate can be calculated for every given node on the grid at a given time by calculating the impact of system emission due to redispatch because of a change in demand or generation at a given node. And this calculation can be done for every given location on an hourly or sub-hourly basis in either day-ahead or real-time market, given the system condition. And we can show a brief example of how this can be calculated in a constrained 3-bus power flow example. In this interconnected system, we have 3 substations. On bus A, we have a natural gas combined cycle generator, have a 400 kilogram CO2 per megawatt hour emission rate, and a $38 megawatt hour bid price. On location B, we have a wind generator at 0 emission rate and 0 bid. And on location C, we don't have any generation, but have 15 megawatt of load. And each of these 3 buses are connected by identical transmission lines. With line BC have a thermal transmission limit of 20 megawatt hours. And if you solve this optimal power flow example, the optimization solver will tell you that the solution for this is to generate 41 megawatt from generator A and 11 megawatt from generation B. And that is because we could not fully utilize generator B's potential, even though it's 0 emission and 0 bid, because we have a constraint on the transfer limit from point B to point C. And if we do this calculation based on this solution, we can see the total cost for serving load in the system is $1,058. And it averages down to about $30 per megawatt hour. And the total emission is 16,400 kilograms of CO2 to an average of 315 kilograms of CO2 per megawatt hour. But these average numbers doesn't really mean anything, because we know in a deregulated market, price is determined by the shadow price on generators, and it is calculated for every node as the locational marginal price. So, if we solve this system, we will see to serve an incremental load at point B, we actually need to decrease the generation of generator B by 1 megawatt and increase generation at generator A by 2 megawatt. And what this means is, the system impact of increasing load at load C would be $76, and that is indeed the locational marginal price at point C. And on bus B, because every incremental load can be met by the 0 cost and 0 emission generation from the wind generator, the LMP at point B is 0, and the LMP at point A is $38, which is a bid for generator A. And similarly, taking the same logic, we can compute the locational marginal emission rate for every single node on this system. Doing the same math, we can see that the locational marginal emission rate at point C is 800 kilograms per megawatt hour. At point A is 400, and point B is 0 kilogram of CO2 per megawatt hour. And compared to the average emission rate, this sends a distinct signal for each substation on this network, because this would correctly inform us if I'm indeed a flexible load and can shift my load between each of these 3 substations. It would make a lot of sense for me, both cost-wise and emission-wise, to shift the load from location C to location B. And that information is not conveyed with the average emission rate or the average cost on each of the 3 branches. So from this example, we can know that the locational marginal emission rate sends the correct signal to load and generator on where and when they should be generating in a constrained interconnected system. And this calculation logic can be applied to the wider system. Indeed, PJM has started publishing locational marginal emission rate for every single substation in their network on a 5-minute basis since September of 2021. And I've taken the data reported from January 1st, 2023 to the end of July this year and plotted out what the zonal locational marginal emission rate is reported by PJM and compare them to the average emission rate also reported by PJM. As you can see this graph, from this graph, the left-hand graph shows the January to February locational marginal emission rate. The middle one shows a spring value from March to May, and the latest one shows the first half of the summer from June to end of July. As you can see, each zone have drastically different locational marginal emission rate compared to what is reported as a PJM average. What is interesting to see, you can see, even though there's a system-wide increase in emission rate going from winter to summer, every zone is impacted by this differently. And what I think is the most obvious example is on the top left corner, that area footprint of Commonwealth Edison. In PJM operation, Commonwealth Edison hosts a lot of the onshore wind projects, and frequently and occasionally sees curtailment of offshore wind because of transmission issues. And if you look at this graph, you can see that ComEd is actually one of the cleanest area in PJM in the spring. And in the line graph, you can see a clear distinction in the spring graph that the lowest line is noticeably separated from the rest of the pack. And that line is Commonwealth Edison. Because of pocketed wind generation, it sometimes observes zero locational marginal emission rate because of stranded wind generation. And this signal is simply not present in the system-wide average emission rate. But this is important for investors to know, because if you invest more wind in ComEd, you risk being curtailed, and your energy is not going to be displacing any of the thermal generation, especially coal that's still running in PJM footprint. We can also take a look at the hourly average shape of locational marginal emission rate in every zone of PJM and compare them to system-wide average emission rate. Again, I broke the 7 months of PJM actual data into 3 seasons: winter, spring, and summer. And you can see clearly that no matter which season you are looking at, the locational marginal emission rate sees a wide spread between load zone to load zone, and sees much noticeable variation from hour to hour compared to the rather flat average emission rate number. In some hours in spring and the summer, the lowest emission area had observed an emission rate is only about 50 and 40% of the highest emission area. And this is important because if I want to invest in a renewable energy asset for the sole purpose of displacing carbon, I would want to site it in an area where I can observe high carbon emissions and displace thermal emission as much as I can. An average emission rate does not really tell me where I should be doing that. But looking at the zonal locational marginal emission rate, it's clearly that some areas of PJM is a lot dirtier than other parts of PJM. So having looked at how we calculate locational marginal emission rate and what the actual reported PJM locational marginal emission rate is, and what information it can convey that cannot be obtained from average emission rate, I want to go over some use cases of locational marginal emission rate in the thinking and strategizing of voluntary renewable energy procurement, and how people are using them and thinking about using them. There are three primary applications for locational marginal emission rate in the corporate and or voluntary renewable energy area. The first is to use locational marginal emission rate to optimize site selection for project to maximize amount of carbon displaced per dollar invested in clean energy projects. Secondly, locational marginal emission rate can also provide a signal for dispatchable load, demand response, and storage to be dispatched to reduce carbon. If you recall, in my brief discussion of the greenhouse gas protocol, GHG protocol currently account megawatt hours. They don't account for carbon. So investors had a hard time to attribute their operation of battery storage and DER to their sustainability reporting because batteries do not produce megawatt hour of energy. They consume energy. But if you operate it correctly based on emission rate, you can in fact displace carbon, and marginal emission rate provide a way to quantify that and to be reported in a carbon accounting spreadsheet. And thirdly, because LMER can assign carbon impact to transmission assets by accounting for emission impact of every asset on the system, it can allow corporate sustainability capital to take part in the transmission investment that's already needed for decarbonizing the grid. So I can start with a more detailed description of each use cases. The first one is that locational marginal emission rate can maximize carbon displacement impact of renewable energy investment. Right now, the status quo for corporate carbon accounting and corporate renewable investment is using the GHG protocol's Scope 2 guideline doing market-based accounting. As I discussed before, this accounting method and strategies focuses on procuring as much megawatt hours of energy as possible. So the most popular strategy for corporations now is called an annual energy matching strategy. In this strategy, they account for the amount of electricity they consume annually and try to procure as much energy as they possibly can to reduce their net consumption, so they can claim net zero or reduce their carbon footprint. Some companies has taken it a step further, trying to reduce the footprint of the energy procurement to do local constraint on annual energy matching. So one strategy is called local annual matching strategy, where they try to confine their renewable energy procurement into the same balancing authority as their load. And some entities has taken it even a step further to do hourly energy matching strategy, where they try to procure energy around the clock. So for every hour, they try to procure enough renewable energy in the same balancing authority to displace their entire load in that hour. However, all three of these strategies still focuses on megawatt hour of energy, not on carbon. And that creates a disconnect between where that investment is, the metric for evaluating this project and the overall goal of displacing carbon. And using marginal emission rate, we can translate the megawatt hour of energy produced by renewable assets into kilogram of CO2 per megawatt displaced from the electric grid. And this way, corporations can target carbon emission and carbon displacement directly. And we call this strategy a carbon matching strategy. And our team recently did a study and published a white paper on comparison of all these four strategies. And our finding that the carbon matching strategy provide the maximum impact for renewable investment in terms of carbon displacement. In terms of overall strategy cost to serve load, it's the lowest cost. It has the lowest cost per megawatt hour of load served. And in terms of abatement cost, in dollar spent to displace a metric ton of carbon dioxide emission, it is also the lowest cost among all three strategies. And it's only a fraction of the cost of the hourly energy matching strategy proposed by some industry practitioners. So by adopting locational marginal emission rate into project evaluation, corporations can target areas and projects that have the maximum carbon displacement and attack the issue of carbon emission directly. This will lead to low abatement cost and high return on investment on the carbon front. Just to give an example of the difference between these two strategies, the traditional strategy of megawatt-hour matching projects are evaluated on the net procurement cost. So this is a difference between their PPA cost and then the resale, subtracted from that, the resale value of the energy. As you can see from the left-hand side graph, this is a figure I took from our white paper we recently published. We used the publicly published PPA price index for photovoltaic in the United States and the forecasted locational marginal price in each load zone in the US to calculate the net procurement cost of a PV project in most of the balancing authority areas that we studied in. As you can see from this graph, ERCOT has some of the lowest net procurement costs for PV assets, and California also has a decent procurement cost. However, as we mentioned before, these two areas suffer from oversupply of renewable assets and the high curtailment and low emission rate to be displaced. So if we apply locational marginal emission rate and translate the net procurement cost into carbon abatement cost in dollar per metric ton of carbon dioxide displaced, the pricing dynamic change pretty noticeably. From here, we can notice that even though CAISO has a reasonable net procurement cost for renewable assets, the abatement cost is some of the highest among all the load areas we studied. And as we mentioned before, this is because CAISO sees frequent curtailment and has an emission duck curve where the PV generation is not able to capture much displaced emission in the system. Therefore, even though the megawatt hour is cheap, it's not displacing much carbon. Similar story happens in Western ERCOT, even though this place is pretty cheap in terms of net procurement cost for project because it has very good solar irradiation and capacity factor for a hypothetical PV. The transmission constraints severely limit the deliverability of these renewable assets. Therefore, even though it has some of the cheapest net procurement costs, when translated into carbon abatement cost, the projects in Western ERCOT does not look attractive at all in comparison to other areas. So, these are some extreme examples, and we can, using actual nodal locational marginal emission rate, we can even zoom down from the zonal level down to a nodal level and evaluate each project individually to select project that has a maximum carbon impact for a corporate renewable investment. And in terms of who's leading the charge in the corporate renewable scene, there are a group of corporations that form the Emission First Partnership, and their goal is to guide the corporate voluntary procurement from the traditional megawatt-hour matching mindset into a emission-focused, directly targeting carbon approach. And a number of high-tech companies and large energy consumers and investors are contributing to this Emission First Partnership. And if you're interested in their work, you can go on their website and see the publication and related research done for this organization. The second application, as I mentioned, is to provide signal for demand response and storage to reduce emission. As I mentioned, under the current greenhouse gas protocol Scope 2 emission guideline, only RECs can be used to hedge the electricity consumption for corporate consumer because batteries do not produce any energy. They do not get the opportunity to attract corporate investment until very recently, and there's no way to incorporate them into a carbon balance sheet. However, using locational marginal emission rate, we can calculate the exact carbon footprint of battery operation and then use that information to optimize energy storage operation to reduce carbon emission. Right now, most of the energy storage assets are used for revenue generation, peak reduction, with very little regard for carbon emissions. Actually, a new white paper research published just this week looked retrospectively at all the utility battery projects in ERCOT and found that about 80% of ERCOT utility battery projects, all mostly used for revenue generation, are emitting to carbon. So they are not really helping the decarbonization of the grid. They are actually emitting carbon for the sake of generating revenue. But locational marginal emission rate can change that. Using locational marginal emission rate, like the one published in PGM, we can change the optimization logic for battery operation and shift its focus from doing revenue maximizing strategy to emission reduction strategy. So here I did a little example using actual published PGM data using 3 different strategies. On the left-hand side, this is the actual operating data from PGM on the day July 27th, 2023. On this day, PGM announced emergency condition due to extreme high load in the system, asking every thermal generator to stay online to serve load and avoid blackout. So this is a prime day of choice for any assets to do their best to reduce emission and help cleaning up the grid. And I included 3 sets of data for the PSEC territory in PJM. The blue bar chart represents the day-ahead locational marginal price in PSEC, which is a territory covering most of New Jersey. The orange line is the average emission rate for the entire PGM system. And the gray line is the PGM published actual hourly locational marginal emission rate for PGM. And in my example, I assume the 10 megawatt and 40 megawatt hour lithium-ion battery and tasked an optimization program to optimize its discharge and charge operation every hour for the 24-hour period using 3 strategies. The first strategy is to maximize revenue from this operation. The second strategy is to maximize emission reduction using average emission rate as a signal. And the last one is to maximize emission reduction using locational marginal emission rate as a signal. As you can see, because this is a very high load day, PGM announced a state of emergency. All 3 strategies actually reduced carbon footprint, therefore have a negative carbon footprint from their operation. However, the revenue maximizing strategy and the average emission rate guided strategy only replaced a fraction of the carbon that the locational marginal emission rate guided strategy is able to achieve. And the reason is that the locational marginal rate shows much more variability in the system from hour to hour. And this provided a much stronger and clear signal for the optimization problem to capture the difference in emission rate. Whereas the average emission rate is a rather flat line, and because of the loss in round trip efficiency, it needs a decent change in emission rate to make an impact on emission rate. And generally, it cycles much less than the locational marginal emission rate guided strategy, and only displaces about somewhat between a third and a quarter of the emission reduction that can be achieved by an LMER guided strategy. So there are also other companies and organizations that are working tirelessly to try to develop a framework and strategy to use locational marginal emission rate to incentivize more battery investment, and then to try to change the behavior of operating batteries and try to, in order to increase their carbon displacement potential. So 2 of the organizations that I know is the Energy Storage Solution Consortium. This is a collection of 3 companies working to develop a framework to account for the carbon impact of batteries and provide signals for developers and battery operators to focus more on carbon emission rather than revenue generation strategy that they currently use. And the second one is a new startup born out of Boston, Tierra Climate, who published a white paper I just mentioned. And their goal is also to provide signal and a commodity for a carbon commodity from battery operations so that they can incentivize battery operators and developers to use their battery to combat carbon emission rather than to purely for profit maximizing strategy. And the third one, I think, is the most interesting one. We all know that to go to a 100% clean grid, transmission is a key to unlock more renewable potential. However, transmission does not produce RECs, as I mentioned before, because they don't provide RECs, they don't land on the radar of corporate energy buyers. And there's no way to account for emission benefit of transmission assets. But I think, being in the electricity market and system industry as we all are, we know that a greener grid will not happen unless we build more transmission lines and grid enhancing technologies. And for that to happen, I think it would be very helpful to unlock the corporate sustainability capital into transmission investment. And to do that, we first need a framework to account for carbon benefit from these transmission assets and projects. Going back to this example we looked at, the 3-bus example, there is no way for an average emission rate-based accounting to account for the carbon impact of this line. Even though when you solve this equation, you will notice that any increase in the transfer capability from point B to point C will provide very noticeable reduction in the system emissions. But when we look at the scope 2 and scope 1 emissions, they are using the average grid emission rate, and you can only assign emission to generators and load. And being an average figure, it also doesn't differentiate between the impact on carbon emission at different load locations. As we see, if we use a traditional scope 2 emission, we observe the same emission rate on all 3 buses, even though using load at substation B has no carbon impact, and using load at substation C has 800 kilogram per megawatt hour carbon impact, which is twice as much as location A. But shifting to a locational marginal emission rate-based accounting can change that. I'm not going to go into too much details, but using LMER, we can redistribute the system-wide emission, which is as we calculated, 16,400 kilograms. This can be attributed to each asset on the system, most importantly to transmission lines on their carbon impact. As we see line B to C, an increase in transfer capability on this line would greatly reduce system emissions. And if we do the full locational marginal emission rate-based accounting, this line has the highest carbon displacement potential. And if this is any signal, it will incentivize more investment in expanding the transfer capability in from line B to C, which would further unlock the generation capability from the wind generator at location B and reduce carbon emissions. To get a more detailed understanding of how this accounting works, you can read the a research paper published by my colleagues Alex and Pablo that they published 12 years ago. The link is here that can do a more detailed accounting than I can afford to given the time limit. Unfortunately, this is a very nascent concept of using locational marginal emission rate to incentivize transmission projects. But I sincerely hope that, more work to be done in this area to unlock more capital for transmission investment in the near future. So a recap, the locational marginal emission rate provides a transparent and reliable way to report granular emission data. On a nodal basis and on an hourly and sub-hourly basis. And it provides a way to redistribute system emissions to every asset on the grid, not just generation assets. And the application for locational marginal emission rates provide the right information for advancing grid decarbonization. First, it improves renewable project selection for maximizing carbon displacement. It can also optimize demand response and energy storage operation to reduce emission. And last and most importantly, it can provide carbon impact value for non-generation assets, especially transmission, to unlock sustainability capital to provide much needed capital into the transmission, much needed capital and interest into transmission development, and unlock more renewable potential in the US. So that's my presentation. Thank you for listening. I hope we have 10 minutes for questions.
Okay, Henk. Thank you for that. Let's go ahead, and there's a fair number of questions that have popped into the Slido, so let's just go see how far we can get through them. The first one is, does your study account for battery storage? I think you talked around that, but go ahead and take another crack at it.
Yes, we do take account into battery storage. So, in our comparison of procurement strategies, the analysis take into battery storage both as a carbon displacement vehicle in the carbon matching strategy, but most importantly, it is used as a generation a load serving entity for the hourly energy matching strategy. You need a lot of them to shift renewable intermittent energy to fit your load on an hourly basis. So they were definitely considered.
Yes. Question about MISO. Are there such estimates publicly available for MISO?
No, we've talked to the people in MISO that can calculate this, and they definitely have the capability to calculate this, but there are some resistance from internal stakeholders from publishing this information. So the hope is we're trying to gather more and more stakeholders to push the ISOs into publishing this. And I know a lot of the companies that I mentioned in the Emission First Partnership and then the Energy Storage Consortium is working to influence that decision to have this data be made available in more RTOs and ISOs.
Okay. Maybe it'll catch on. What is the intuition behind the lower cost of the carbon matching strategy compared to the other strategies? Does the cost vary greatly by industry?
I'm not sure what it means by industry, but I can answer the first part of the question. Compared to the local constraint, the carbon matching strategy allows you to procure projects anywhere. And because carbon, if you calculate locational marginal emission rate, you can translate energy into carbon. But the local annual matching and the hourly local matching, you are confined to the same ISO balancing authority as your load. So if you have a load in CAISO, you have to procure energy in CAISO. And that, as I've shown in this presentation, CAISO is not a good place to invest renewables. You are going to get curtailed, and the emission rate is already low, so you are not displacing much thermal generation. So your investment has very low carbon impact, and you have to procure more energy to meet that. So therefore, the energy matching strategy place additional constraint on your optimization problem, so to speak, increases your cost compared to the carbon matching, where you are not confined to any balancing authority.
Okay. Okay, next question. How is double counting avoided? Counting as renewable energy for which the REC in that hour has already been sold?
All the projects in our white paper were assumed to be conform to the additionality principle. So the REC will be retired by whoever the REC will be retired by whoever claims that carbon credit. So there is no double counting in that calculation framework.
Okay. A question from Zach Ming at E3. Since curtailed renewable generation does not generate RECs, how are curtailment statistics relevant to REC effectiveness?
When generation is curtailed, they reduce the marginal emission rate on the system, and that means you have unlocked renewables. Because the emission rate is lower, it means additional renewable assets is not displacing any thermal generation in the system. So that is an indication that that area already has saturated renewable generation. And if you are carbon focused, you should be taking your investment elsewhere and not in CAISO and ERCOT.
Okay. Next question, is this work based entirely on an analysis of historical data, and how relevant is it for future planning?
This analysis is done on simulated 2025 data. And we also published another paper in Electricity Journal that looked at the forecasted 10-year operation. So when you are making a 15-year PPA procurement decision, you definitely need to look at what's going to happen on the market 15 years down the road. Some places have an aggressive clean energy policy and will have a very sharp reduction in emission rate, and then and then reduce the ability for your projects to capture carbon displacement. Other areas like SPP and MISO, these states don't have any RPS, so your projects can be safer there in terms of their carbon displacement potential. So yeah, some in our study we definitely looked at the future trend of locational marginal emission rate and the future trend of system capacity and generation mix.
Okay. Here's an interesting one. Would a national carbon price have the same effect as the LMER scheme?
Definitely. A national carbon price is probably the best thing we can hope for to incentivize carbon emission, because if you use a carbon price, all that emission will be translated into price. So there are already trading instruments for transmission lines in terms of their impact on the grid. So a carbon price would just directly translate the emission impact of transmission lines into that these existing financial instruments. But without a carbon price, our thinking is locational marginal emission rate is the next best thing we can do without a national carbon price implemented to send the right signal to investors and developers to how to operate and build their projects to decarbonize the grid.
Okay. I have to confess, I don't remember if this was something you said or that was on your slide, but please clarify what is meant by greenhouse gas protocol does not account for greenhouse gas emissions.
Greenhouse gas protocol does. It uses average emission rate, but most importantly, it focuses on accounting for megawatt hour of energy. So you are not you are accounting for emission based on your load megawatt hour and your generation megawatt hour, and these things don't directly translate into emission, and that's what people are having trouble with using RECs to guide investment, because RECs no longer translate directly into emission. Not all RECs are created equal in the system, depending on where they are.
Okay.
And I think I want to add to that greenhouse gas protocol is indeed undergoing a revision process, and they collected the feedback from a wide range of industry practitioners. And I think more than half of the surveyors indicated that they want the guidelines to take into account more granular emission information. So that means more granular to a nodal or zonal level, and more granular in a time on a time horizon too. So that that leads pretty directly into a locational marginal emission focused thinking framework.
All right. Next question, slides will be provided, so don't worry about that. The speaker said REC procurement and ERCOT drives development of new wind in regions subject to curtailment. Could evidence for this please be provided?
Yeah, I mean, there are a lot of solar in the queue for ERCOT, like even though we show that there's 8 terawatt hours of curtailment in total in ERCOT. So as long as we're still counting megawatt hours, projects will still be building ERCOT because it's the cheapest place. And if you look at the PPA index, there are still a long interconnection queue of projects and developers building projects in ERCOT. So yeah, that's it.
That's there. Okay. What is LMER when additional renewables are not deliverable at a given location?
Sorry, Charlie, my computer just.
Yeah, let me repeat that.
Yeah.
The question is, what is LMER when additional renewables are not deliverable at a given location?
Well, when it's not deliverable by the location, it's zero because it's trapped and it's not generation. So when a renewable generation is trapped, it is a marginal generator.
Because the marginal generator's emission rate is zero, it will become zero. And that's pretty obvious from the graph I showed for PGM, right? ComEd consistently observes noticeably lower LMER in the spring in that graph. And that's because in the spring, the wind generation is high compared to summer, but the load is pretty low. So if you look at the curtailment data, ComEd sees a lot of wind curtailment in the spring season, and that translated into lower average locational marginal emission rate because in some hours or 15-minute intervals, wind is being curtailed from ComEd, and that's producing zero marginal emission rate.
Okay. We're about at the top of the hour, so I think we're going to need to wrap it up. I want to thank Hank for this very timely webinar and for the great insights into the future of clean energy procurement. And as I mentioned earlier, an email will go out once the video file has been posted, and we'll answer the questions we didn't get to and get them posted as quickly as possible, including the links that were referenced in the questions. We appreciate your engagement and look forward to seeing you again soon. We have another webinar coming up on August 21 on National Grid ESO's distributed restart project in the UK, looking at system black start with distributed resources, followed by our fall workshop at the end of October. Further information on all of our webinars and meetings can be found on our website at esig.energy under events and in our newsletters and informational emails, and you're all invited to attend. Hank, thank you once again for this very timely and informative webinar, and thank all of you for your interest. We look forward to seeing you again in the near future. And in the meantime, everyone, take care, stay safe, and thanks for your participation. See you soon.
Thank you, Charlie. Thank you, everyone.